It will be chaos. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it's an election shocker, and what I want to understand, this is something that political elites don't see coming. Not even consumers see this coming, yet history shows us that the economy is likely to be devastated by the results. Now, I need you to understand the current state of the economy and what expectations are, and then I'm going to show you why it's going to be total chaos after it's over. Now let's over to Bloomberg, where we picked today's story up with a headline: as Fed's favorite inflation gauge and consumer spending barely rise. And as we look at a pulse of where the economy's at right now, we're not seeing signs of this soft landing or no landing scenario that the Fed has told everybody that we're likely to see. But they've done such a good job that they've driven expectations that it's still going to happen because the media believes it and they're pushing it, and that means consumers believe it, but the data is starting to suggest otherwise. As a so-called core personal consumption expenditures price index, this is the Fed's preferred gauge of inflation, which excludes volatile food and energy, increased a mere 0.1% from July. That was the smallest gain in 3 months, which is good news for seeing inflation cool off. And on a 3-month annualized basis, the measure rose 2.1%, right in line with the central bank's target. So what we're seeing here is the core personal consumption expenditures, which is a function of demand coming out of factories, is actually cooling off here, coming right in line with targets. But the expectation here is we're going to see an economic boom. The problem is history is going to tell us the opposite is going to happen. Spending only rose 0.1% after adjusting for inflation as consumers pared back their spending. Nominal personal income, which is not inflation adjusted, increased 0.2%, and the savings rate, which is most important, we're going to focus on that here, eased to 4.8%. So what we're seeing here is signs of demand going down, and we're seeing a shift in consumer savings habit, and this doesn't tell us that the economy is about to boom. In fact, it's setting up for the exact opposite to happen. Let's take a look at the savings rate. We're going to compare this to the personal consumption expenditures index. This is the headline, including food and energy. And what I want you to see is that decelerations or disinflationary trends in the PCE are often matched by a rise in personal savings rates. Now, the question is, what is driving consumers to save? Does it happen to be that we came off some very low levels? Well, there's some other factors here, but we can see this decline heading into the Fed's 2% target is largely met by the fact that consumers feel that something about the economy is causing them to save more money. And what that has to do with everything is with the labor market. So when we look at the unemployment rate shown in blue against the personal savings rate, what we see is as consumers save and consume less, well, it means other people start to see their hours cut, others then lose their jobs, and that leads to a rising unemployment rate. And as consumers start to see other people lose their jobs and perhaps even see their hours get cut, or maybe even things slow down in their business, they start to cut their spending because they don't know how the economy's change is going to affect them. So they begin to save, consume less, and that's the trend we're seeing over and over. You see that going into the 90s recession here, as savings rate led to an increase in unemployment. It happened again going into the dot-com bubble, very clearly during the financial crisis. In fact, drove the unemployment rate up to multi-decade highs as the savings rate continued to rise, and now we see that trend again. The savings rate slowly moving in an upward direction against a rising unemployment rate, telling us that we are seeing dangerous signs for the economy, that perhaps consumers aren't that confident in it. And the problem is, when consumers start to lack this confidence, history tells us that we're going to see all-out chaos. I'll show you why in a little bit, but let's continue to look at the current state of the economy. The PCE price index slowed to 2.2%, which is heading right in line with the Fed's 2% target. But look at the core PCE. It's at 2.7, but remember the 3-month annualized rate is telling us it's coming down. The key, though, is consumer spending. You see inflation-adjusted spending, again, only up 0.1%. And this rise in spending was driven by a pickup in outlays on services. And this is a problem because what did we see here in the manufacturing sector? All the survey data continues to tell us there's a slowdown. that demand is falling. Hours worked are getting cut. Jobs are getting cut. Now, we're not seeing this in, of course, the government data, but we are seeing it in the survey, and that led to an overall services spending rising by 0.2%, while goods spending was unchanged. So any notion that we're going to see an increase in demand on the factory side, well, that's highly unlikely. And while wages and salaries rose by the most since May, growth in disposable income slowed. Now, disposable income is very important here because the more disposable income consumers have, they can do two things with it. They can spend it, or as we're seeing, they're starting to save it. It's the latter part that's dangerous for the economy, and that was restrained by declines in proprietors' income, interest income, and dividend income. But one way it could be going up is your trading income. Check this out. On September 13th, I've showed you this trade on uranium for our subscribers to our CTA Timer Pro. What we do is we look at machine positioning every day, and we see the machines are deep short and price moves against them. Well, we trigger that on our reports. In fact, we even noted based on our backtest data, this was a high probability trade, and so good as of close of business yesterday. Our subscribers who took this trade are up almost 12.5%. Now look at our results here. This is incredible. We currently have 8 open trades on our CTA Timer Pro. 6 are up. That's a 75% win rate. That is huge. But maybe you like to trade the RSI and the MACD and those other momentum indicators, but you can't get it right. Well, we look at them over a long period of time, and we run a proprietary overlay. But look at our success rate. 75% right now. That is incredible. Makes trading easy. And how easy? 2 hours every day before market opens, we publish the reports and my opinions. You pick the trade, put it, buy it, open, add a stop loss, and then go about your life. Don't sit in front of the computer all day. Don't watch your phone. And then once a week, update those stop losses, profit, and it makes things easy. You get the reports, the signals, my opinions, the backtest data, stop loss levels, full tracking, weekly updates. Here's the best part, 30-day free trial. So you can make money trading. Start putting money in your pocket. Links in the description below, because based on what we're seeing in the economy, everyone's going to be looking to make extra money, and now you have the edge, my friends. Let's take a look at what this real disposable personal income means for the economy, because while the data says it looks pretty good, it doesn't transmit into the economy. So we look at advanced retail sales. This is inflation adjusted, or it's called real retail sales. That's in blue. And what do you see? That real disposable personal income, well, it's fairly consistent. In fact, you can see there are times where real retail sales declines, and nothing changed with personal incomes. In fact, it didn't really change much during the global financial crisis, and it's certainly not changing now. And what this is telling us is that consumer preferences are shifting. They're not consuming. They're now looking to save money because they see the economy is starting to slow down. So as we now shift and look at consumer sentiment, we're going to start looking at the history of what happens after elections. It's going to outright shock you. As we now look at U.S. consumer sentiment, it rises to a 5-month high on economy views. And this should be good news, because this should lead to more spending, as when consumers are confident about the economy, they go out and they put real money into it. And yet we're just seeing the opposite, that the savings rate still remains on an upward trend, broadly speaking, and that doesn't bode well to what we're seeing in these survey reports, that consumers are saying they're starting to get more confident. But as you're going to see, it has something to do with the election. But what in reality, what follows the election, well, history says it's going to be total chaos. As U.S. consumer sentiment continued to rise in late September, reaching a 5-month high, and more optimism about the economy in the wake of the Federal Reserve's interest rate cut. And this is exactly what the Fed wants to happen. They want people to believe in the magic of the federal funds rate, and the media does a great job of telling people and spreading the word that, hey, the Fed's cutting rates, and this is really going to ease financial conditions and inject liquidity into the markets, and everybody's going to benefit. It's going to make a big difference. And yet history shows when the Fed cuts rates, it is not bullish for the economy. It means something's going wrong, because what then we see after that is further Fed rate cuts, and nothing actually changes. But you'll note that it's important to see consumer sentiment here shifting on that, because they want to believe things are getting better, but they're not. The University of Michigan's final September sentiment index rose to 70.1 from the 69 preliminary reading. The latest figure issued Friday follows an August index of 67.9. So we do see a clear upward trend in sentiment, but notably it has the opposite effect when you start looking at the federal funds rate. Here you see the University of Michigan Consumer Sentiment Survey in blue against the federal funds rate. And so the initial reaction is the Fed's cutting, consumers get excited, and then they find out that, wait a minute, the Fed's cutting not because they're trying to unleash the economy from a restrained position, but because the economy is actually headed down. You can see when the Fed cuts, sentiment falls to the downside. You see it here around 95, 96. And here we look at right before the dot-com bubble. What happened? Sentiment popped, and then it dropped. And look again, going into the global financial crisis, the same thing happened. The Fed said, hey, we're cutting. People got excited until they realized, whoops, the Fed got this wrong. In fact, the only time sentiment really didn't plunge was as we headed into the pandemic before it crashed. And this time, consumers want to believe that a couple rate cuts are going to improve their financial conditions. It's not going to do that. And let's talk about inflation, because consumers expect prices to rise at an annual rate of 2.7% over the next year. This is the lowest since the end of 2020 and down from the 2.8 expected last month. They saw inflation rising 3.1% over the next 5 to 10 years, even though we know the actual numbers are likely to be lower. But what's driving this view? It has everything to do with gasoline prices. As we look at the University of Michigan's inflation expectations in blue, and we've got U.S. regular all formations gas prices overlaid in red, you can see the very clear relationship. As gas prices go down and consumers get excited, it means more money in their pocket. And while expectations early in the month showed some concerns about the labor market, we did hear that from the conference board as well. Consumers' view about unemployment improved in latter weeks, as the report showed. This reflected in part the Fed's decision to lower rates, and this is just supporting the myth of the Federal Reserve, because everybody is struggling right now. Households are falling behind. Businesses don't understand why consumers aren't spending, and everybody wants to believe that it's all because of the Fed. And the Fed supported this view. Fed Chair Powell said, hey, I'm going to restrain the economy. I'm going to over-tighten policy because we need to bring inflation down, and when I cut rates, you're going to watch all of a sudden there's pent-up demand, the economy is going to boom, but I'm going to show you why that's not going to happen. But let's talk about, of course, the election, as some 55% of the respondents see declining borrowing costs in the coming year, the largest on record. That's leading to improving views of buying conditions for big-ticket items and homes, which were the most upbeat since April, even though consumers don't realize they're not going to be spending. And sentiment appears to be building some momentum as consumers' expectations for the economy brightens. At the same time, many consumers continue to report that their expectations, this is perfect, hinge on the results of the upcoming election. So they're basing their happiness about the economy on the upcoming election. But what they don't realize is that history shows us it's going to be total chaos. Let's take a look first at, of course, the effect of the federal funds rate on the unemployment rate, and the notion that this is going to reverse anything. Well, it's not going to happen. You see, when the Fed starts to cut rates, it means the economy is slowing, and that doesn't have anything to do to arrest the rise in the unemployment rate. You see that going into every recession, and a cut of the federal funds rate is going to do nothing to stop the rise in unemployment. But let's talk about the election outcome, because we can look at the University of Michigan Consumer Sentiment Survey against election outcomes, and here's what you can see. A president gets elected. Now we're going back to the 1950s when Eisenhower got elected. What happened? Sentiment fell. It fell after Kennedy. How about Johnson? It rose briefly and then fell. Nixon, it fell. Nixon again, it fell. Carter, declined. How about Reagan? Well, he got a little bit of a boost before it declined. The second time it declined. Bush, it declined. Clinton, well, he actually won this race. He was the first one to actually see a sustained rise in sentiment the first time and the second time. But how about Bush? Well, it went down again a second time. How about Obama? Well, he came in at the bottom, which helps everybody. It didn't stop the fact it declined before it went up, and then he saw another rise in sentiment. How about former President Trump? Well, he benefited from a rise in sentiment before, of course, the pandemic hit. But look at Biden. It plummeted. Now the setup is it's very low. Sentiment can't get worse. But history shows that after elections, sentiment plummets. And that leads to all-out chaos, because when sentiment goes down, well, spending drops too. And the university's current conditions gauge rose to a 3-month high of 63.3, while the expectations index increased to the highest level since April. Consumer outlook for their financial situations climbed to a 4-month high in September, as their views of the economy over the coming year were most upbeat since March. But there's a problem. It's not transmitting into the economy. And so here we can see, going back to the sentiment survey, and when you see a rising unemployment rate, you can actually see sentiment go up. But it doesn't transmit into spending. You see that happen here in the 90s, the dot-com bubble. You can see as the unemployment rate rose, people wanted to believe, but belief, again, doesn't turn into spending and demand. You see, of course, during the global financial crisis, sentiment plunged and then rallied as, of course, more people lost their job. Now everyone wants to believe, but there's one part they're missing, is belief doesn't transmit to spending. This is the issue here. You see a decline in sentiment leads, of course, to consumers spending less money in the real economy. When you do that, that puts more Americans on the unemployment line. Those who do get to keep their job end up working less, and that leads, of course, into a recession. And so the chaos that's going to likely follow this election may have nothing to do with the outcome, but it has everything to do with economic fundamentals and the fact that the likeliness that our economy is headed into a recession and an all-out financial crisis. Well, what that means is many Americans, in fact, many workers all over the world, are going to be on the unemployment line, and that, my friends, is going to be total chaos. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.